Welcome to Credit Matters, the podcast where credit absolutely matters. I'm your host, Shankar Ramakrishnan, head of US credit and global market engagement at Informa Global Markets. And I'm joined by my co host, Bruce Clark, head of rates market coverage at IGM. So, just to kick it off, it has been a relatively busy week in bond issuance in the first half before a pause on Wednesday for the Federal Reserve's decision on interest rates. And then the rest of this week, as sentiment slipped on more news on the Iran conflict, pushed oil prices higher, there were no deals in the investment grade bond market. So the Fed, it almost did what was expected, but then the market was taking the messaging out of the decision, which the Fed did differently. So, Bruce, can you unpack a little bit on what did the Fed do the right thing? What is the messaging which people took from that?
Yeah, good morning, Shanks. It's been a week of very dramatic repricing of Fed policy expectations and of the interest rate curve. Prior to Wednesday, the financial markets broadly were fairly sanguine. I wouldn't say sanguine, but they were willing to look through the Iran conflict. And then things escalated on Wednesday with attacks on energy infrastructure in the region and Qatar and back and forth. Anyway, that has produced a relentless drive higher in oil prices. And we had no fewer than 6 central bank meetings this week. And the central bankers took the opportunity to weigh in on what they thought of things. And the net result being that they're concerned about supply chain disruptions. Now, they perhaps appear overly nervous about that because, as you'll recall, when was the last supply chain disruption? COVID. And they all sat around like potted plants for a year, while supply chain inflation created a problem. They were late to respond. This time it appears as though they're trying to, their memories are still fresh enough that they're trying to get ahead of the game.
Right.
Not so much the Fed. The Fed said, normally we try to look through energy shocks. Let's be patient. Let's wait and see. Very different response in the UK and Europe, where central bankers are just saying, "Hey, look, rate hikes are on the table," and both of those countries, both Europe and both Europe and the UK, now have 3 rate hikes priced in by year end.
Right.
And for the first time in this entire cycle, the futures market, as we speak, the futures market in the U.S. is pricing a small chance of a rate hike by the end of the year. Now, before the war started, just 3 weeks ago,
the
market was discounting 2.5 rate cuts, so 60 basis points of rate cuts. At the beginning of this week, it was still discounting 22 basis points of rate cuts. Now they're looking at a rate hike. So as you can see, the whole policy trajectory has been turned upside down. And so I'm not totally surprised that the corporate credit market has just decided to take a step back here and let the dust settle.
So that is interesting. And then I think at this point, I would like to introduce our special guest, Meghan Robson, the head of US credit strategy at BNP. Meghan is responsible for developing the bank's view on US corporate credit, especially the investment grade, high yield, and leveraged loan markets. Welcome, Meghan. Welcome.
Thanks for having me. It's great to be here.
Thank you. So before, thank you for joining us on this one. I actually wanted to get your view on the Fed decision. What did you make in terms of the impact it will have on corporate credit markets?
Yeah, I think Bruce summarized very well. We're starting to see this hawkish move globally in terms of central bank reaction function. In U.S. markets, I think the credit reaction has still been relatively muted to the meeting this week. I think Powell did sort of leave things a little bit open to follow the data, to follow the conflict. But I think the market is definitely coming around to the idea that we're no longer going to see necessarily several rate cuts this year. And BNP has been of the view that the Fed would be on hold for 2026.
Oh,
And rewind, not even 3 weeks ago, but rewind to the end of 2025, when we're marketing our outlooks, I think one clear assumption that stood out to us from investors was this assumption that the Fed was going to just be able to deliver 3 or 4 rate cuts this year, that Trump would get his nominee in, that the Fed would be able to be dovish almost regardless of the path of inflation. So we've really come a long way now today to price even potential for a rate hike. I think that the risk for credit is, in the April meeting, if the Fed were to come out and be a bit more clear, and that they have a more of a dual, equally weighted cut or hike, that those are both of equal consideration, I think that credit would react more negatively. I think Powell was still vague enough that that credit didn't sell off too much and was still focused on the other risks in the market.
do you agree that rates at some point will start going up, instead of being cut? Is that the view at this point? Does it hold water, you think?
I think for our baseline has been no cut scenario. So I think the market's pretty close in the US to that scenario. And then we have assumed that the Treasury would be between this 425 and 450 level throughout 2026. So we had gotten closer to this 4%, and now we're a bit higher here, and we do see inflation as being a bit stickier than others on the good side. This was before, of course, all of this geopolitical conflict. So I think it increases that risk, but we're not yet expecting a large sell-off in rates. I think we really have to watch inflation expectations and that break-even yield. If that starts to climb higher, then I think that risk of a rate sell-off really rises.
Right. And do you see credit spreads as generally widening, or because they are almost around in a range and they're hardly moving? There is no impact we are seeing from all this, risk in the background. Do you expect that to have an impact on credit spreads at all?
So we have, it depends what market you look in, but investment grade credit spreads have quietly, widened almost 20 basis points since the tight level that we saw in January. So in January, we were trading close to 70 basis points, and we widened, to the 90 basis point level. That's, as on a percentage basis, that's a pretty large widening. But to your point, we have been range bound. Spreads are still overall historically tight, and I think part of that is we are still very much, despite all the risks, we are in this mid-cycle environment where corporate balance sheets as a whole still look pretty healthy to us. Earnings have held up okay. GDP growth has been positive, not too hot. And then the Fed, I think the central banks is the key question. Does that change? Because it's hard to be mid-cycle if central banks start hiking. But for now, we assume that they are on hold, which I think is what the market's pricing in at the moment.
For the most part, I think that the Fed is being the calm central bank here relative to the Brits and the Europeans. In my view, Meghan, what's your view of the economy? I mean, you mentioned that corporate earnings remain strong. We just came off, fourth quarter earnings season, which was the 6th consecutive quarter of double-digit earnings growth, and I believe that the forecast for Q1 here is also a double-digit number. What do you think of the economy in general outside of inflation? I mean, you think that we're on solid footing here, or is there a risk that the employment market or employment conditions deteriorate?
we think the economy is still solid, so we're projecting 2.5% GDP growth this year. I think one key point our economists have made, and Powell got to this in his conference about the labor market, is just your break even level of labor additions or hiring is so much lower now in this environment, while you have this supply shock of immigration and less labor in the system. So our team estimates that the non-farm payrolls number of 0 to 20K is actually going to be break even for the economy at these levels. So despite we did see a negative labor report in February, where we saw actually negative job gains. But if you take a step back and look more at the 3-month average, we think hiring is still on a good pace and positive. And so we still feel comfortable with the labor market and GDP growth.
Yeah, it wasn't that long ago when 100,000 jobs a month was considered the break even.
Right.
Right. Oh,
So,
it's just a huge structural shift going
right.
on.
And like, what kind of investment strategy would you like in this kind of environment? Is there, like, if I had $100, where would you actually put in, and how would you suggest people should be investing at this point?
Yeah, so I focus on mostly corporate cash credit markets, and I think
Right.
we have a couple key recommendations now. So we do think investment grade has underperformed a bit relative to the leveraged finance markets. We also see investment grade as a little bit more insulated to some of the AI disruption themes, and we can go into that a little bit. But I think that IG has these hyperscalers and is sort of more of a beneficiary of data center growth. Companies are more solid, I think. So we do like adding to investment grade in this environment.
Right.
And then I think the key thing under the surface is in leveraged finance markets, we think that investors can still be invested despite exposure to software, and there's a lot of interesting places that still have value. We think cyclicals look quite attractive as well.
So when you say AI disruption, I think software, everyone has been selling software saying that's the one which is going to get affected. So is that true? Like, or there are winners and losers in that space as well, I guess. Yeah.
It's a great question. I think what's really fascinating about software and software risk has really driven a lot of large market moves, whether it's headlines around private credit or underperformance of leveraged loans in our market. But I think the key point is we still haven't seen fundamental evidence that really AI disruption is underway, when it will be underway, how large the impact will be. So far it's been a very sentiment-driven type of sell-off and not a fundamental one. I think to your point, on the surface, it seems like what we've been calling is horizontal software companies that potentially have more of a generic type of business offering to a broad set of industries, potentially could be more at risk of being replaced versus those vertical software, vertically integrated, where you might have proprietary data or specialty industry expertise. So we see that subsegment as a bit more insulated. But I think looking at credit markets broadly, leveraged loans have this 11 to 20% software exposure, and it's a broad range depending on what you categorize as software. High yield, in comparison, only has 4%. So I think high yield can be seen as a bit of a safe haven if investors are worried about the software risk.
And basically pocket the yield as well, I guess. Yeah. If you're investing high yield, probably you get a better pickup than investment grade as well. So why not pocket the yield, pick the winners, that kind of stuff. Yeah.
Yeah, exactly. I think the opportunity in high yield is the rotation that you did get somewhat of a penalty for just being labeled leveraged finance in this world of risk aversion around private credit, smaller issuers. But within yield, I think places like chemicals, autos, you would think would be vulnerable in this geopolitical conflict, but actually because Europe is so much more vulnerable as an energy importer. We're even seeing these cyclical sectors in the high yield market that normally would be vulnerable to geopolitics actually perform really well as investors sort of shift away from Europe into the US, and cyclicals has been one of those beneficiaries.
Oh, wow, interesting. And Megan, do you see, like, there is so much noise about private credit at this point, right? Like everyone is talking about cracks in private credit. Is there something to worry about? Is there like some because what is actually happening which is causing all this concern in private credit?
It's a great question. The headlines and the cracks, I think, continue on a daily and weekly cadence
Right.
in terms of private credit. Our view is we're not expecting a full-fledged default cycle. We don't think there's obvious systemic risks that we see, but we do think there's so much leverage in the system that and debt growth biased in the private credit area that we do think it's something that will continue to see some idiosyncratic issues, and we'll have to work through some stressed credits. And just a few examples of why this has become a problem.
Right.
When you're a credit strategist, you're just starting out, you're trying to gauge where the risks are. One of the most simple things we look at is just debt growth throughout the cycle. And you can look at debt growth of sectors, of markets, and private credit has really just outsized debt growth across high yield loans. And then within private credit, it's really software that has driven a lot of that debt growth. So, rewind the past 20 years, the credit cycles we've seen telecom in the late 90s. In 2015, 2016, it was energy and high yield. Those are all places where we had enormous debt growth. So I think that's that points you to that area being a problem. And then I think what's unique about private credit this time around is the transparency. And there's a lack of transparency in a lot of these vehicles. It's hard to get information on them. The issuers are private, smaller. As a credit strategist, I want to be able to dig into all the company fundamentals and always do that. So I think it's hard to really tell the market or prove to the market that everything's okay without as much transparency as you can have in public. But I will go back to the point I had made earlier is, software, yes, it's a risk, but we still haven't seen tons of hard evidence that these companies' earnings are dropping. And so that's why we're still, hesitant to identify this as a full-fledged default cycle.
Yeah, to that point, Megan, what would be a red flag for you for that sector, or what would cause you to think that this is a systemic issue, or there is going to be a systemic issue? We all think back to the housing crisis when the famous subprime is contained statement, and things like that, just red flags that pop up that sort of mark turning points. And I mean, I happen to agree with you. You read the headlines and you see, so and so wrote their fund down to zero, and or they're gating withdrawals, and you're like, well, that seems like kind of a big deal, but it just hasn't amounted to a whole lot.
No, but to add to that, actually, the other thing which I thought was interesting is also the leverage which banks are providing to these private credit outfits as well, right? So there is some kind of correlation with the banks, where people are kind of selling banks as well when the private credit news comes in. How do you perceive all this?
From my perspective, what I would watch for to be much more concerned, I think, is a drop of earnings. And we've estimated around a 20% drop broad-based for, let's say, the software sector. That is when, if you look at your average private credit issuer, they have about 1.3 times interest coverage, we think. So their earnings covers interest at the level of 1.3. If earnings is cut by 20%, and forward-looking as well, they're hovering around that 1 times interest coverage. And that is, instead of being like a single B type of company, you're a triple C company. And that's when default risks really rise. So if that were to happen, and you still have these BDC redemptions happening at a quarterly cadence, they are likely to continue to offer or to deliver on redemptions at the 5% threshold level. If that fundamental stress happens at the same time, instead of being able to sell an illiquid pool of loans at close to par, it would be marking those loans a lot lower. and that's when you actually see losses taken. I think one great example we saw this quarter, one BDC was able to sell a pool of loans near 97 cents on the dollar. So, what is in those loans? Was it just their higher quality loans? We're not sure, but the fact that they still are able to execute $1 billion portfolio in the secondary market to a handful of investors close to par tells us there's not major concern. If the loans are marked a lot lower in BDCs, they have some tests that they have to meet for regulatory purposes. So an asset coverage test is one. That's their value of the assets they hold, so loans over debt. If that starts to be challenged, it would be challenged because of the mark to markets coming lower. Then I think that's when we could have some real knock-on effects.
Gotcha. So keep an eye on earnings is what you're saying. And that's I follow the corporate just as a macro guy. I follow the corporate earnings season fairly closely, and it was just like the fourth quarter, the estimates started out with for the S&P 500 started out with an 8 handle, ended up quite a bit higher than almost double that. I'm up at 14 something, I think, and so. Yeah, I hear you. I mean, all these different problems with disruption and private equity and private credit, just, earnings continue to be fairly solid, like you say.
And do you think people should be hedging at this point, Meghan? Because there's a lot of talk about people putting on hedges against all this, nervousness and the risk and everything. Do you think it still makes sense? I think this market generally goes unhedged mostly, right?
I think tail hedges in the macro, using macro products, options, can give you some peace of mind, but they also can become expensive if you get the timing wrong. Is this an issue 2 years down the road, or is it an issue 6 months down the road? So I think that's why it's challenging to have hedges in place that are too large in size. We've also seen investors put on hedging through baskets, so equity baskets of things like insurance equities rather, or the BDC, a basket of BDC equities. Those are other ways that investors have also tried to hedge exposure in the market.
So is there like CDS? You're talking about like credit default swaps, and even the treasury market volatility. Do you see a lot of locks, or that like selling the treasury and locking the yield? Is that going on as well? Do you see that happening?
We don't see it. I don't see as much as the activity in the treasury market. I think that we have seen a lot of CDX. So high yield CDX is a good proxy for just broad credit risk. Even though high yield has less software exposure, it would still widen meaningfully if we did see issues pick up. So I think that's one tool. If you had a view on specific company, you can use the single name CDS as well. And then for tail hedges, you can use the options, credit options market. And then our equity desk here does have some baskets that investors can implement, which gives you a very liquid equity type of exposure to the risk.
Like you said earlier, is it going to be 6 months away, or is it 2 years away? The risk. I think people still haven't got that. There is still a lot of optimism about where we are going, I guess. Yeah. Is that how you would see? You think people are still very optimistic?
I think credit investors are optimistic, and they do point, and one reason for that might be the maturity wall of a lot of these companies is in 2028 or 2029. And so I think there's a perception we have some room before really like meaningful principal payments are due to the lenders. One challenge I do have to that is, we talked about the drop in earnings and interest coverage is you could have problems with interest coverage before hitting that maturity wall. But I think the fact that we're longer dated here, and then also credit investors will point to, we're senior as a credit investor to equity. And so there's some hope that if problems do happen, you could recover something through the equity.
And do you already see investors differentiating between like winners and losers? Like in the primary markets, at least, do you see some borrowers getting more interest than others, and some sector differentiation or the type of credit? Do you see, and what kind of differentiation are you seeing?
It's a great question, and I think it's one of the first areas that we could start to see an impact to public markets is some tightening in credit conditions for, like you just said, certain type of issuers, an issuer profile, a sector. So far, we haven't seen a ton of evidence. There was a tech-related deal in the leveraged finance market that didn't actually end up pricing. So I think that is probably a first early example of some lack of investor appetite for those type of credits. But broadly, I think that the story, at least in investment grade supply, we think is a K-shaped story for issuance this year, where a lot of sectors that are growing more slowly are actually not seeing a lot of supply, and all the issuance is really concentrated in the hyperscalers, utilities, and a few sectors that are doing more M&A. And so far, the appetite for those deals has been still very high. Investors are worried about kind of being left behind of the data center story. And so despite this really quick buildup in leverage for some of these IG issuers, even doubling their leverage levels, investors are, you're seeing that the deals are oversubscribed multiple times.
And the oversubscription, should we take it seriously? Sometimes people are padding up orders just to get allocations.
I guess you have to, yeah, I think that you can compare the oversubscription though to subscription levels in other deals. And so I think that of course there is, sometimes it will be slightly inflated, but I think you can compare it to other deals in the market and still get a good sense of the demand there.
So Meghan, as we wrap up Q1, what should we be looking for into Q2 and into next month more specifically? Are we slaves to headlines out of the Middle East, or is there something else on your radar?
I think the geopolitics is front and center for us. We looked at 15 past conflicts in the Middle East, and the usual playbook outside of September 11th really has been credit has shrugged off in the past. The headlines this time seems different. Like I said, IG spreads are 20 wider. High yield is about 30 wider since January. So we've seen a larger magnitude move already, and actually the widening is similar, very similar to the first leg of widening we saw in the Russia-Ukraine war. So there was a sell-off during that war. We saw somewhat of a recovery, and then we really saw spreads sell off much more meaningfully. So I think that right now what we're watching is really what we were talking about at the top is like, do we see a more material sell-off in rates driven by worries about inflation? Does this Fed hiking narrative come back into play? And if that's the case, then credit spreads could be more vulnerable to a further sell-off here. So I think that will be key. In April, we'll start to get some data, inflationary data, more consumer expectations around how all of this is impacting their decisions.
Right. It's been fairly quick. It's only been a couple of days. We've gone from an easing expectation to now perhaps a tightening expectation. So it's going to take a little while for all the dust to settle until investors decide what they want to do with that. But yeah, it's an unusual situation.
And how seriously should you take this? Like, it almost seems very flippant, right? Like one day it's up, the other day is really down. Is it like should you trade on this, or how do you behave?
I think we need to watch the data. I think that there's still so much uncertainty. I think that you can't follow too closely the day-to-day probabilities of what's being priced in. But I do believe the bar for either a cut or a hike here is pretty high. And so I think it does put us into this hold. It does put us firmly into this hold camp for some time. And then it means that people who are quite dovish will probably be disappointed that no matter who the nominee is, it might just be more difficult for them to deliver on those cuts. But for credit markets, I think 25 basis point hike, 50 basis point hike is much less of a risk than the AI disruption story that we've been watching.
Right. Yeah. I just don't think whoever ends up as Fed chair, I just don't think they'd have the votes to do anything right now, right? To cut, even if the president wanted them to, I don't think they'd get the votes. So
Especially with the comments from Powell about potentially staying on
Right.
longer. You know,
Right.
he
Right.
left that open. So there's that adds to your argument.
And in some sense, the credit markets are acting like the adults in the room, right? Like they're not overly panicking about anything. They're not pricing in anything. They're not hedging. Seems like they seem to be holding on to see how this whole thing plays out before they start making some great moves, I guess. Yeah.
We have something called our credit positioning indicator, and it gives you a sense of how either long risk or short risk, underweight or overweight investors are. And right now, credit investors, according to our indicator, are slightly short, so they're underweight risk. And so to us, that tells us they do have capacity to add to risk if there was a positive surprise.
Right.
I think the reason that we haven't widened more than we have is potentially because investors were already kind of underweight in the credit market, so they didn't have a lot of beta to really trim here.
Right.
So I think that has helped. The positioning has definitely helped the stability picture hold.
And actually, one of these questions we get asked this question, and I wanted to, what is your advice to people who are joining this field? Like, how do you become a credit strategist? What do you need to do to become a credit? How do I become Meghan Robson?
I think curiosity is, having a lot of curiosity is probably the most important. I don't think you need to be the smartest person, but you need to be willing to continually ask questions. I think being persistent is also, we will be tackling problems all the time. You'll go down one road and your analysis will lead nowhere. You'll have to start over, and that happens all the time. So I think a willingness to sort of fail and then just remain persistent and trying
Right.
to answer questions are two of the big qualities. And I think just really being willing to learn about anything. And as you know, just think about on this podcast the number of topics we've covered. You have to sort of
Right.
start from scratch and try to learn as quickly as possible.
But is it like your job? I think how do you stand out from everyone? There's a lot of competition, a lot of people writing great reports. You write fantastic reports, but how do you stand out? Like, what do you need to do? Is it a good headline, or the analysis has to be deep? How do you grab attention?
Yeah, I think that you want to have your own edge or your own your own flavor that you focus on. So for us at BNP in credit research, we really do try to take more of a fundamental angle. So spending more time on where fundamentals are going is one way. We
Right.
try to differentiate. I think a second is on the quant side. We have a really robust set of quant indicators on Bloomberg. They drive our views, but also they're sort of the baseline framework for how we build our view, and we can explain, I think, in a logical manner, like how we think things are mid-cycle based on these indicators. So I think that's our approach, but each strategist brings something different to the table and is able to
Right.
their own skills and their experience.
What's the metric for your success? I come from the trading side, which it's fairly black or white. You got a job review every day of the year. You either make money or you don't. But what's the metric in your field for success?
It's a combination. It's a combination of things. We do have, so at BNP, we're technically part of the trading desk. Every piece of research we write has a trade idea attached to it. So
Right.
we have a trade tracker. We have a trade tracker where there is a bit of a scoreboard, for better or worse sometimes, but you get to see how your ideas have actually done in the market, and there's an open date, a trade open, a trade close. So
you've got skin in the game. I mean, not unlike traders.
Yes, that's exactly right. And we work with our traders and hopefully helping them guide risk taking. And then I think the second piece is client impact. The type of clients that you're and the magnitude of clients, those interactions are both important. How many people are reading your notes?
Right.
There's the detail is really incredible. You can see even how far people have read the note and where they focused on what page and things like that. So you have a lot of data in terms of, are you being impactful? Are the clients you're meeting with working with BNP?
Right.
Factors like that are what they look at.
How many views you get on this podcast?
And so, Meghan, can I ask you this? Like, what is this AI disruption? Do you think in your field, do you think AI is going to disrupt your field as well? Like some robot is going to do all the work?
I think it will. I think it will raise the bar for some of the repetitive tasks that
Right.
our team and research in generally does. If you're updating a daily movers, a daily index move type of sheet, I think that's something that we would love to have agentic AI, set up and just automatically send out for us. But I think it also gives a big opportunity to enhance research, to make it more interesting with the natural language processing. I think during earnings season, there's been a lot of developments of scraping earnings statements for, either whether it's concerns about inflation, lower income consumer, AI disruption, and you can really have a good picture for
Right.
sectors, what names are talking about those risks. So I think that really can elevate the type of work. The type of work that we're doing is really exciting opportunity. We're hoping to continually build on.
Thank you very much for this, and that's all we have time for. And thank you for tuning in to Credit Matters, because it absolutely does. And don't forget to subscribe to our podcast on YouTube, Spotify, Apple, and wherever you get your podcasts. Next week, we'll dig into more credit events and trends shaping the markets. If you like real-time reports and market data, you can request a free trial of IGM services. You should, and the link is in the show notes. Thanks again for listening. Thank you very much, Meghan. Thank you.
Thanks, Meghan.
That was awesome. Thank you. Thank you, Bruce. And have a great weekend.